we're going to kick off with funnel management and benchmarks. The reason that we need this is that the syndicate has some very unique characteristics, right? In this vehicle, decision control, capital allocation is given to our investors, which presents risk to you as a syndicate lead operate this. How we lack predictability of capital. So this is always the number one thing that syndicate leads talk about, or one of the top few things that we always talk about. Now, when I think about building and optimizing a syndicate, I think about optimization from two perspectives. There's the top down, which is investor scale. Investor scale drives access to capital. And the bottoms up view is actually operating efficiency, which means being efficient with the time, energy, and the out-of-pocket costs of running this. When we look at investor scale, why is this important? We know by now that scaling an investor network has a correlation with your check size, and that also drives our upside, and we're all economically interested creatures. Second, we know that the larger average check size also correlates with cash economics, not just the carried interest value, but the cash component of what we do also improves with check size. Law of large numbers. Having a large investor base basically means fundraising predictability. That's valuable to us. Having a lot of investors also means lower dependency risk on one or a few investors. So if you ask me, in order to raise $1 million, I would rather have 100 investors writing 10K checks than 10 investors writing 100K check each. The reason is because in the latter scenario, you have a 10% dependency risk on any single investor. Of course, with the scale of the network, you need the right infrastructure and tooling and automation and skills to manage this scale so that you're not drowning in it. But assuming you can cope with the scale, then I would say having a more diversified investor base is better. And scale is also important because, as we'll see later today, having a large investor network has a self-reinforcing referral loop. So your investor network grows on its own, but again, you need sufficient base for this to be possible. And on the operating efficiency side, we know that the cash economics of Syndicate are unpredictable. We effectively only get paid on cash when we get deals done. So you want to minimize out-of-pocket costs to compensate for the lumpiness. Second, a lot of you might be side hustling. And so if that's the case, the time and energy that you spend on doing this is expensive time and bandwidth. So you want to be efficient with doing this. Now, something that I have a bit of a gripe with is that venture tools somehow cost 10 times more than regular ones, and they do maybe 10% more. It's easy to spend thousands of dollars a year, and you're going to be forking out of pocket on this. So I've seen many syndicates and groups make these mistakes, right? Just copying the tech stack of a VC, you're going to be paying for it out of pocket. And the question is, do you need it? Is it an efficient use of your capital? And last thing is, as a syndicate, we don't get compensated for a lot of things we do on the back end, the deal sourcing, the DD, on all the deals that we don't get done. Okay, so for all of these reasons, we think about scale and also efficiency. So with that said, we have a 5-step funnel management process for managing our syndicate and to measure success. We're taking a concept from sales management and applying it to the syndicate vehicle, because every deal that we do is effectively selling a fundraise. So it's a pretty appropriate analogy. The funnel that we've developed looks like this. The first stage is investor outreach. So what is the universe of investors that you target, or the people that come find you? So that's the initial top of funnel pool. From there, it brings us to stage 2. We want to convert them to be part of our syndicate to share with them our deal flow. So stage 2 is building that network. Stage 3 is publishing our deals out to this network, so getting eyeballs on our deal flow. Then stage 4 is engaging investors. Some portion of the investor network is going to be engaged on any particular deal. And after those, we want to nurture them to an investment. And this is where capital falls out. We also have a referral loop. The referral loop for investor acquisition tends to happen firstly from stage 4. When investors are engaged on a deal, they are more likely to tell their friends, their network, other investors about your deal and your syndicate. So that's one acquisition channel. The other one is on stage 5, the investment stage, when an investor has either made a mental, a psychological decision or an explicit decision to invest in a deal. They're also far more likely to introduce other investors to the deal. We like these referral loops because even though the effect is small, we're skipping a lot of the funnel stages, and a new investor introduced to us through stage 4 and 5 basically goes right to stage 4, right? The investor is immediately bought in on, yes, you have a syndicate, you have deal flow. And by the way, this is the specific deal that we're talking about. So you're in effect one step away from closing capital, right? So this is why, even though it's small, it's a very powerful effect. Now, when I work with syndicates and train new angel groups, when they are doing this, I get some benchmarks around getting your syndicate to critical mass, right? Launching your first deal, that first milestone tends to be about 50 to 70 investors before launching your first deal. And then the next milestone is above 100 investors. We have enough numbers where the full set of funnel metrics prove out, right? Below that, the numbers are a little bit lumpy. There's fluctuations. And at bottom of funnel, the numbers are not strong enough, right? It doesn't give us strong enough indicators, especially on the referrals. So what I'm going to present to you here is basically benchmark data on the different funnel stages when you are between 100 to 200 investor scale. So the first one is the conversion between investor outreach for them to join your syndicate, right? You find an investor or they find you. You're telling them about your syndicate, and all we're asking for at this point is we're saying to them, hey, I'm a credible investor. Here's what I invest in. All I want to do is to share with you deal flow. I'm not expecting more commitments from that. If you're pitching well, targeting well, you should be closing at 70 to 80% call success rate. So we do the one-to-one onboarding, and at this stage, you should be getting 70 to 80% yeses to share your deal flow. I'll say that today, I built a completely inbound referral loop. So all the investors that I acquire are referred into me. So it's virtually 100% to me. The only time it's less than that is when somebody I feel is not a fit, they don't quite understand venture, and I choose not to accept their money. Now, when we publish a deal out, remember, we talked about this in session 2, the magic number is 3. Investors need to hear about a deal 3 times. You need to have a compelling reason to go to investors each time about a deal. But they need to hear about a deal 3 times before you maximize interest. The good benchmark around at this scale of investor network is that 22% of your investors should be expressing interest in the deal. Okay, so that's the number. And out of those people, you should be seeing 29% commitment rates. So 29% of engaged investors end up committing capital into the deal. The only missing variable here is your minimum check size. A lot of that is going to be driven by your minimum check policy. So if you take that number, you have a pretty good estimation of how much allocation you should ask for. Now, in session 2, we covered this, which is our 14-step deal lifecycle, end-to-end, what happens in an operating syndicate from the deal flow layer to the fundraising stage to the administration process. And I highlighted step number 5, which is publishing our deal memo, publishing a deal to investors, and best practices and a framework for communicating that deal out. And we presented this framework. We gave this what I call our 10-line messaging framework for how I communicate deals out to investors. And it consists of 4 parts. The first one is the identity statement. What do we say about a deal to establish identity? And it's a good practice to have a call to action, let's say a pitch deck link to guide investors to the deal. Second is we want a hook. We want to say something interesting or compelling about the deal. Why are they interesting? And it depends on what you have to work with on the company. The level 3 message is quantification. You establish what the company is. You said something interesting. Now give some numbers to back it up. What do investors care about? Hard numbers like revenue and growth matters. De-risking is important, right? Show social proof or non-revenue traction like user acquisition. You can rely on things like founder pedigree features. Something that we've established already before is that in the funnel management, in the funnel process, deal publication is the bottleneck. And we benchmark that number to 22%. What I'm going to show you here is the evolution of how deal engagement evolves. Remember, we have this process whereby we put a deal in front of investors 3 times to maximize interest. And as you do this, the engagement builds, right? You acquire new investors who look at the deal each time. In this particular case study, I'm going to show you what our engagement numbers look like through the life cycle. In this particular deal, on August 11, I published the deal and we had 630 investors, top of funnel, looking at it. Out of that, 112 people expressed interest in some form. So we captured 17.5 deal engagement. A couple of weeks later, I announced that I'm having a CEO call. During that time, we picked up a couple of new investors. And so our total base is 632. Our engaged investors grew up to 130. So this brings our deal engagement to 20.5%. And then the third activation after the founder call was to ask for commitments. We grew our pool by another 8 investors. Now we're up to 640. We got 6 more engaged investors. So now the total is 21%. This pattern that plays out basically says that in this case study, 70 to 75% of deal interest comes from the first activation when we publish a deal out to investors. I will say that every time I do, the same pattern plays out, which means that the deal publication, what you say to investors, how you say it is vitally important because a lot of the deal interest is going to come from this one single touch point, which is why I pay so much attention to how we publish the deal, the best practices around this, because a lot of the success hinges on this one single event. And if you look at the funnel numbers, we also see that engagement is the bottleneck in this whole process. This is another reason to pay attention to this. Okay. Now, going back to our funnel, I also talked about this referral loop. It's pretty hard to measure. I estimate it at maybe 1 to 2% referral-based acquisitions on any single deal. This is simply just anecdotal evidence that I have. And so why am I making this argument? What proof do I have to say that this actually exists? To prove this point, I'm going to go back in time and to show you when I started my syndicate, the patterns that I was observing. What you're looking at here on this blue line is data from my CRM. It basically tracks the number of investors subscribed to my deal flow on my CRM over time. When I was starting out, I noticed that every time I was active with a deal, either I published a new deal, I was giving updates, I was communicating with investors, I started to get intros. I started to get people requesting access to the data room, right? People that I didn't know. The only way they would have been able to find the deal is that my existing investors forwarded an email onto somebody and that somebody else requested access. They wouldn't have found it otherwise. And it wasn't clear to me if there was a consistent pattern or is this just noise? So this is why I put together the data. I went back to my inbox. I looked at my calendar and to try and map out events. And what we pieced together was like this. In May of 2020, I announced my first startup. And in July, I ran the syndicate itself. So I was giving updates, communicating with investors, all of that stuff. I announced my second deal in July and I ran the syndicate in December. Then we did startup number 3 towards the end of 2020 into early 2021. And then we also layered on another syndicate deal at the end of 2020. If you look at these events against the timescale, you start to see a pretty clear correlation pattern between deal activity and growth in the investor network. So this is like my proof of the referral effects working. Today, I spend no time looking for new investors. They get referred into me from my network, investors knowing that I have a syndicate, and also through this vector, which is when I do a deal, I know my investors, the people who are really engaged on it, they're going to reach out to their network and say, hey, you should talk to Jed about this deal. I think you'll find it interesting. Okay, so this for me is my number one LP acquisition lever today, and it costs $0, but it only works at scale, which is an argument of why you should invest time into building a large investor network.